Welcome to the Breadth of Experience, where we break down some interesting stories that may not be getting much of the headlines when it comes to the stock markets. And in this special three-part series, I'm joined by one of our regular guests, Global PM, Damien Fernandez, and James Hunter, a first-time guest who's also one of our PMs managing a range of Canadian portfolios. So, from surprising sector shifts, the resurgence in Canadian equities, to global competition rising up and taco tariffs, stay tuned to find out more. Welcome, gentlemen. Damien, longtime guest of Breadth of Experience. But today, we are also joined by James. Welcome, James, to the Breadth of Experience. And Damien, you're obviously intimately familiar with James. You've seen him, I guess, blossom from a caterpillar, from a pupa all the way to a caterpillar, right? I guess.
Well, a butterfly.
Butterfly. Oh yeah, I'm getting my
You're getting your well. Actually,
my
James,
biology wrong. Yeah.
For those that listening, like James and I have known each other for going on close to maybe 2 decades. He started off in a similar program I did at a firm, and we were brought into TD, and I was involved in bringing James over because from a previous life, I could see the butterfly wings slowly sprouting at I could in advance, and it's been it's been a wonderful addition to the team.
So what is James? Tell your story. He's obviously seen it, the origin story. I've seen it as well, being part of this team.
Yeah, I guess it would date back probably 15 years is when I first met Damien at a previous employer, and we had both gone through the rotational program in the investment division of an insurance company, and it was a good experience. There were a lot of young people there at that time, and we all learned a lot, got our CFAs, and I found out at that time that TDM was building out the equity research function. Met Damien and a number of our colleagues, and it was a really good transition for me in 2014. Just as it turns out, just when a bull market in equities was starting, so it was good timing.
Yeah. And so, what have you done since then at 2014 at TDM? And you've now taken on some mandates. So let's elaborate.
Yeah, well, I guess at that time I joined as an analyst, like I said, in the research team, and I was covering energy, and we sort of joke on the team, like when I started, oil prices were about $100 a barrel. They went straight down for a few years, so it was tough coverage. Then I moved over to pipelines, utilities, REITs. Those were sort of out of favor for a few more years, and then I took over coverage of the banks and insurers at the top of the market, 2022, just before the U.S. regional banking crisis. So I've had my fair share of seeing like how things can go bad, and you learn a lot in those experiences. So it's been really good for my development. And a couple of years ago, I took over some of the income mandates. So I now lead all the preferred share institutional and retail portfolios. And just the end of last year, took over the TD monthly income fund. So some pretty big, important mandates for the firm.
Yes. And so bull markets make you complacent, but bear markets teach you a lot in some sense, right?
Top ticking markets, just not the funds.
Well, you've, as you said, taken over monthly income in late last year, but late last year was also the time, let's say, the new president comes in. It's been an interesting time for you the last 6 months, taking over this strategy. And if you take an ordinary person and give them the S&P 500 at the end of last year, 5,881, and the S&P 500 as of yesterday's close, June 3rd, 5,970. It almost feels like nothing could have happened. But it's actually pretty much the exact opposite. We've round-tripped some serious lows. We've gone through some volatile times, kind of a mix of COVID, other tantrums. What are your thoughts? What are the takeaways of just looking at the last 3-4 months? It's been fairly eventful, to say the least. Damien, I'll start out with you.
The exciting thing actually is that Josie, you talked about S&P returns. Most people on this podcast listening in are actually Canadian investors, and what's really interesting is that James, and as a representative of our Canadian franchise, is actually materially outperforming for our clients. Well, in an absolute sense, right? But the TSX is up 7-8% year to date. The S&P, while you talked about numbers that were flat, the S&P actually for our Canadian clients is down, right, year to date because of the Canadian dollar is up. So the way I think about this, right, if you look globally and you look at equity markets, and I can talk about, the S&P flat, the TSX up high single digits, if not close to double digits, Europe up double digits, Japan, Hong Kong up high single digit, double digits. On the face of it, it feels like the sentiment is much worse than reality. And if I had to summarize it, I think I would go with that. Like sentiment, how people feel, talking to our clients, it feels like everyone's looking around the corner for the recession, and like the recession is imminent. It is now, and
This has been the
markets.
case for some time too, right?
Completely, right? And our team will take the other side of that, like, because we're fundamentalists, not in the religious sense, right? Fundamentalists in like looking at and earnings, like James, in your coverage, earnings are growing, like companies are cautious, but EPS is up, cash flow production's up. Like that's what drives valuation. I'm not sure if you want to add to that.
Yeah, just to build on that point. So if you reflect on, the last 3, 5, 10 years for Canada, like there's been, I would say there's been a bit of a rough patch. Obviously, there's been a lot of, challenges with the pandemic and then coming out of the pandemic, but economic growth has slowed, and I think the productivity challenge in Canada is well known, and so that's put a sort of a dampener on how people feel about the economy and their job prospects and even just like their day-to-day household finances. But that underneath all that has been a bit of a, you might call it like a stealth rally in Canadian stocks. And I think what we're benefiting from is a sort of low starting valuations, low expectations, but also this underlying tone of inflation in both Canada and the US. It's good for a lot of the earnings power of the big Canadian stocks, and we've avoided a recession, which has been important and helpful for the financials.
To that point, James, let's unpack that a little bit. As you rightly said, the feelings of the general Canadian population may be a little subdued, but underneath the hood, the market is working. So what is the market sniffing out? Is it a sign that growth is coming back to Canada, or is it a sign that we were really depressed and it's just kind of valuation kind of getting a bit of a lift off? What is it?
Yeah, so it is probably a bit of both. I think the primary factor is that we've exited this zero inflation, zero interest rate world, which was a key feature of the 2010s, and that really held back the profitability of banks and life insurance companies and other parts of the market. So I think that underlying tone of inflation is coming down, but it's not going to drop back down to 0 or 1%. I think that's really important for the publicly traded companies in Canada. That's one factor. And I do think the other factor is just that we've had some policy decisions that haven't been super business friendly. If you think about the bank tax that we had a couple of years, the Canadian recovery dividend, like there were big capital gains taxes, uncertainty around that. Like so there were policy decisions that weren't business friendly, but are now, looks like we're tilting into a different direction as a country. And so I think the market is getting more positive about some of those dynamics as well.
Looking as we're global, but observing the Canadian marketplace, it's an idea of that, and we've talked about this before, Joe. It's like better than feared.
We've
Like,
been saying that for 2 years plus.
and it keeps repeating itself. The banks. So, for example, the biggest part of the TSX is the Canadian banks. They just reported last week, and maybe James can summarize it. But people were really downbeat, expecting like significant loan losses and provision increases. Numbers were fine, and outside of Royal, all the banks were up 2 to 5%. Like, James, like, is it just that?
Totally. Yeah, expectations coming into the quarter were definitely low. People are worried about provisioning going higher,
All the tariffs were supposed to really impact us,
are
yeah?
really supposed to flow through into the results, and we haven't seen that. Wealth earnings up double digits, capital markets earnings up double digits, pre-tax, pre-provision at a bank level across the big banks. I think it was over 10% growth year over year, and provisions inched up quarter over quarter, but it wasn't a big move higher. And importantly, it was more in the performing provisions rather than the impaired provisions. So actual loan losses aren't really coming through. So there's that, and there's also capital generation has been really good. like the ROEs are improving. The banks are generating a lot of capital, so it's allowing also some dividend hikes, which is good.
So, whichever side of the spectrum you may be politically, everyone likes economic growth. And you said something about policies over there. Do you think the policy shift is sustainable? And more importantly, what is their ability to actually execute? And what do you think about that? Like, what is the risk that the market may not be seeing?
Maybe I'll start with Canada. Damien can talk about the U.S. I think if you think about the infrastructure backdrop in Canada, like yesterday we got an announcement that the Eglinton Crosstown LRT is finally going to finish this September after like 15 years and being billions of dollars over budget, right? I'm really waiting for that one personally because it would help my commute to and from the office. But I think it's emblematic of a lot of the challenges we've had here. We have a lot of population growth in Canada, and we're just not building out infrastructure. That's an intentional choice that can be changed. And I think it is going to get better. Maybe it's not going to be perfect, but it's going to get better in the next 3-5 years. And that's something that investors will take notice of. That's just one small picture. But I also think, like, in terms of resources, more development of precious metals, rare earths, maybe less negativity around the oil patch. I think that could be beneficial as well.
Damien, you've said that if we start changing stuff, if we break down the interprovincial barriers, if we make, it's almost like we should erect a statue of Trump, because it's like he's forcing us to, like, what is your take here? Yeah.
Maybe erect a statue of Trump in like the as like in the prairies in the farming country, like as a scarecrow, just to keep the no, but just taking a step back and putting my like my Canadian patriotic hat on. Despite Trump's antagonism to our country, what's actually happened is that he's galvanized our nation to actually focus on what you said this at the start, Joseph, what matters, like growth. Right? Growth lifts all boats. And for the last few years, we were in the wilderness to a certain degree of navel gazing, focused on priorities that didn't address what actually lifts people up, which is economic growth. And now, look, 6 months ago, the Liberals, and I don't, this is not a political statement, I'm just calling it as is. 6 months ago, the Liberals were lost in the wilderness.
Didn't stand a chance.
Exactly. And 6 weeks ago, or, 2 months ago, there was really no discernible policy differences between the Liberals and Conservative platforms because they both focused on growth. They both talked about, talked about policies to improve economic growth. They talked about, removing interprovincial trade barriers. The sacred cows in the Liberal platform, like a carbon tax, gone, right? Capital gains tax, gone. So I do think this, and by the way, we started this talking about returns globally, like, Trump has single-handedly galvanized individual countries to take policy steps to improve their own economic growth. We talk about, make America great again. It's like, I was thinking about, we should call it like, big global equities great again.
Great. Yeah.
Right. Because like global equities, because of policy decisions being enacted in those countries to improve economic growth higher than the trend rate before, is actually making global equity markets competitive versus the U.S.
This is the question. Is it just all this returns you're seeing across the board, and even the resurgence in Canadian equities? Is it just a sign that countries are competing, and competition is generally better for risk assets as a whole?
They're getting relatively better.